Hey guys, it's Patrick. Have you ever wondered why your property insurance bill keeps getting higher? In Florida, the rate of property insurance has risen 68% in the past 2 years alone, nearly double the national average. What's the cause? Is there a solution? What does this mean for society and for investors? Let's dive in. In 2018, a faulty electric transmission line caused a brush fire that quickly spread. Within 6 hours, the community of Concow and the town of Paradise were nearly completely destroyed. In total, over 16,000 buildings were gone and 85 people lost their lives. 2 years later, Jen Goodland and her family moved from Colorado to Paradise, California. They began building on a lot they had purchased, and when construction was complete, they moved into their new home. In July, she received notice that her insurance premium, which was once $2,500, now was over $11,000 for the same property. Our insurance agent said, "Just be thankful we didn't drop you." And I said, "You did. You just dropped me." Insurance has been around for hundreds of years. You may already know that the first form of insurance was to insure merchants' vessels that were carrying cargo overseas. Merchants were able to expand their fleets, achieve financial stability, trade grew, and society was better off for it. Property insurance is a simple concept and is allocated on a yearly basis, which means it's renewed every year. The owner pays a premium to the insurance provider. In exchange, the insurance provider guarantees the value of the damage done in the case of an unforeseen event. This reduces risk for the owner and provides financial stability. Insurance products are best used for low-frequency, high-severity events that are uncorrelated, but more on this later. Insurance premiums, which are what the policyholder pays the insurance provider to receive that insurance, are based on a couple of factors, such as the value of the asset, the extent of the coverage, and the perceived risk. As you may have guessed, the perceived risk is what we'll be talking most about today. The three main factors that we see influencing insurance pricing are climate change, the nature of insurance pricing, and reinsurance. Let's talk about the elephant in the room first. Climate change. The National Oceanic and Atmospheric Administration has documented a significant rise in severe climate events such as wildfires, droughts, floods, and hurricanes over the past decade. For example, the total cost of all weather-related events in 2020 was over $95 billion. This cost has caused a lot of insurance providers unable to pay or becoming insolvent. In addition, natural disaster attacks insurance's weak point: correlated events. If a provider wants to cover an area with insurance policies, what they typically do is pick a variety of different homes that vary in age and location in a specific market. 1 or 2 homes might burn down from a fire, for example, but on average there will be enough homes to cancel it out. Natural disasters throw this out the window. One large storm or event can cause billions of dollars of damage in a single region at once. This leads to insurance providers having billions of dollars in claims all at the same time. This capacity they are simply unable to handle. As we are beginning to see, insurance providers have responded by raising premiums or by leaving markets or states altogether. Insurance is one of the most highly regulated industries in the United States. All price increases need to be sanctioned by the state governing authority. But what does this mean? In practice, this means that the models that the insurance provider uses to project future claims must be backed by data. The problem comes about because there is no accurate models that can predict these sort of climate events. Oftentimes, insurance providers are not able to justify premium increases to their liking. The easier solution is to leave. Let's talk about reinsurance. Reinsurance is a topic I don't often see discussed when talking about insurance prices, but I find it the most interesting. In short, insurance companies buy insurance. It's almost a sort of insuranceception. What this really means is that insurance companies can purchase a sort of insurance from these reinsurance companies that cover the value of the losses in the case of a climate event. The insurance provider files a claim with the reinsurance company and uses those funds to pay off their own claims. Reinsurance companies, although similar, are funded completely different than a traditional insurance company. Reinsurance tends to be more in the shadows, not in like a scary sense, but just more in the sense that it's out of the public eye. It has unique funding options such as Insurance Linked Securities, or ILS. These are securities backed by, you guessed it, insurance. One of the most common forms of insurance-linked securities are catastrophe bonds, or cat bonds. These mature within 3 to 5 years. However, for the same reasons we've been talking about before, reinsurance companies have also been backing out of the market. They are doing this either by raising their own premiums or reducing the amount of reinsurance coverage available to insurance companies. They don't like paying out billions of dollars with little to no return. Shocking, I know. In addition, in today's economic outlook, investors of reinsurance companies are looking for other alternative investments to put their money in. When an ILS was yielding 15% year over year, when the US 5-year Treasury was under 1%, that looked like a pretty good investment. Now that a 5-year Treasury yields close to 5%, this investment looks much less attractive. Forgive my pun, but this leads to a perfect storm of events. We have insurance providers pulling back because of failures of models and pricing. We have reinsurance stepping back because of perceived risk. And we have investors in these types of assets pulling back due to the economic outlook all at once. All of this leads to higher prices for the consumer. You may be thinking, what is the solution here? How do we solve this? Well, the truth is, natural disasters may start to become a risk that is uninsurable by the private market. We are already seeing in states like Florida, where Citizens, which is the Florida insurer of last resort, holds nearly 20% of the total insurance policies in the state. Theoretically, if the risk of natural disasters could be accurately modeled, there would be a premium that exists that would make insurance make sense. However, we are far from that. Let's go to a real estate example. In 2016, your per unit insurance component of an apartment complex in Miami, Florida, might have been a couple $100 a unit to $1,000 a unit. Now it's more than double that. What is the case when insurance becomes the largest expense line item for these properties? Developers and investors start to pull back. They also begin to raise rents, neither of which are good scenarios for the market. You may be thinking that the solution is to just build better buildings. However, there remains low incentives for developers to build more resilient buildings. Insurance premiums are relatively high across the board, irrespective of the type of building that is constructed. Fundamentally, risks that cannot be modeled cannot be insured. Period. We need better models that don't exist yet. Maybe AI will help us get there. Once you start to get into the hundreds of billions of dollars, private markets become increasingly a less viable solution. The federal government may have to step in at some point in the future, and federally backed insurance has mixed results at best. Property insurance will no longer be an afterthought. Society needs to start thinking about the implications. Where should we be building? Where should we be moving to? How should we build? How should we incentivize long-term proactive thinking? Only then can we effectively navigate these risks. That's all I have, guys. Thanks for watching. Let me know what you think in the comments below. See you next time.